Okay, it's 11:10, everybody. Thank you so much for sticking with us here today. We've got a lot to learn, and I just want to extend a warm welcome to Julie. She's a reverse mortgage loan specialist, and she's got a PowerPoint she's going to share with us. I think you guys are going to find this valuable in this crazy market as an option for folks 55 and under that have equity in their home. So take it away, Julie.
Thank you very much. And thanks everybody for being here today. I know your time is extremely valuable, and I'm really hoping and feel that the time you spend today learning about this will really help you increase some sales when you're in the room with the right people. So I hope that you all find that to be true as well. I'm sure you're familiar with the partnership, the connection between Keller Williams and LevPro. Both Keller Williams ownership and LevPro decided we would be a good fit as a partner for you all, so that if you learn about this financing option for your older home buyers, it'll help you to leverage this program to increase your sales. So that's what we're going to talk about today. Let me see. Okay, now I told you I was fine with these slides, and Alana, and now I can't get them to advance. There we go. Thank you. Okay. All right. So in the.
Do you want to hit record? Oh, it is recording. Okay. No.
Okay, we're recording. Go ahead.
Just wanted to make sure.
Yeah.
Good. Thank you. I appreciate that. So today I'm going to be doing a pretty high level overview in just 20 to 25 minutes, again, to be respectful of everybody's time. But this presentation, an extended version of it, will be available in the chat area, and I can also send it out after the fact as well. And there is a link here, reversefacts.com. That is a link to a toolbox that you want to keep handy. It'll have today's presentation in it, as well as some client-facing materials that you can use when you're talking to a client in this age group who might be interested in this financing. Also, if you'd like some hard copy materials for your office, so that if you make packets up for new clients or potential clients, it's something you can put inside the package, no matter what their age is. Because if you're dealing with a 40-year-old client, they may have a 65-year-old parent in a house that they've outgrown, and something they might be interested in sharing with them to get them in a more aging in place appropriate house. So it's good information for any of your clients to have. When I get done with this presentation, I'll address any questions. You can go ahead and put them in the chat at any time, or just save them for the end, and I'll be happy to stick around as long as you want me to answer those questions once we get to the end. So reverse purchase financing, it's basically a tool that allows your clients of a certain age to combine their one-time investment of funds, which we're going to determine it's different for every buyer because it goes by their age. But they're going to combine their one-time investment of funds with our loaned money to complete the house purchase. So that's the same definition of a traditional mortgage as well. They combine a down payment with a loan to complete the house purchase. But the difference between our loan and a traditional or conventional mortgage is that our loans do not require the homeowners to pay principal or interest mortgage payments monthly. They can make payments, they're optional. Everybody wants to know they have options, but I would suggest about 95% of the people I work with do plan to not make mortgage payments, because they know in their retirement years, the goal is to keep their money lasting as long as possible. They don't know whether they need to fund 5 years of retirement or 30 years of retirement. So it's all about keeping their assets intact and having that good monthly cash flow. So the owner does not build equity as they traditionally do with a regular mortgage, assuming they don't make payments. But if you think about it, if you've got a client of that age getting into a conventional mortgage of 15 or 20 years, for the first few years, they're mostly paying interest anyway, so they're really not getting much equity back. In our loans, they can actually increase equity position for a while if it's a good appreciation market, because they can always sell the house at any time, and anything that they get over and above the payoff of the loan, they're going to get to keep that. So they do get to have the advantage of a good equity position when we have an appreciating market like that. Qualifications for who can use these types of loans. In Pennsylvania, it's age 55 or higher. They need to have their down payment, and it's going to be, again, different for every buyer because it's related to their specific age. We're going to underwrite it to make sure they can meet their home buyer obligations, and they're the same as they are whether they buy with cash, a traditional mortgage, or a reverse mortgage. The homeowner always pays their annual property taxes, HOA dues if applicable. They need to maintain the home, and they need to have homeowners insurance enforced for the value of the house. So those are the same with our loan. It needs to be a primary residence that they're purchasing. They can't use these for a vacation home or any type of a second property. Their source of funds can't be borrowed. It has to be an allowable source. It can be FHA gift money from a family member if they're that fortunate. It can be net proceeds from a departure home. It can be any asset they currently own, retirement funds, investments, anything like that, just not borrowed. And these loans are extremely consumer protective. So one of the protections there is they need to participate in a counseling session, and it's a one-on-one with your client who's purchasing the house and a counselor. It's usually done over the phone, and it takes about 45 minutes. So it's not a big deal, but for somebody who just needs a little more comfort level with this loan, that's actually a very good step for them to go through. So advantages for your clients are also the same advantages for you. It gives your client additional spending power because they're putting a percentage of that home value that they're buying into the deal. They can get that lifestyle of not having a mortgage payment by investing, might be 45 to 60% with the way rates are right now. So they get the same benefit as somebody who pays cash for the house, and that they're not having a monthly mortgage payment obligation, but they can do that without 100% paying cash for the house. Gives them the flexible payment feature. Again, they could make payments. Occasionally I run into somebody who's maybe semi-retired or not retiring for 4 or 5 years, and they do plan to make payments while they're still working, but they will finance this way from day one because they know whenever they feel like it, they can just stop making payments. And your clients can make the buying decision feeling more comfortable that they're not jeopardizing their retirement. They're going to have that good monthly cash flow and not being pulled money out of their retirement accounts to make payments. And again, they can have that mortgage obligation free lifestyle without paying cash for the house and withdrawing some of their retirement funds to do that. Okay, they did a poll of some buyers who use this financing, and this particular slide is saying that 25% of those who finance this way revealed that they would not have purchased the house if they had not known about this purchase option of a reverse mortgage. There's some other survey results that I find a little more powerful. One was how important was the reverse financing option being available to you to your buying decision. And to that question, 72.8% said it was a very important reason that they decided to move ahead and purchase a home. Another question was, did you spend more on the house once you discovered the reverse mortgage for purchase? 27% said that they did in fact spend $50,000 more on the house they were buying once they discovered this program. And 39.3% said they spent over $100,000 more on the house they were buying once they discovered the reverse for purchase. So I think those are some pretty powerful numbers to tell you not only can it increase sales in units, but it's going to increase sales in dollar value as well. There's 2 different distinct loans that we offer that are considered reverse mortgages. My goal is to not make any of you experts in this. I don't want you to feel like you have to say Mr. and Mrs. Smith are going to be good for this program or this program. I'm just going to kind of give you the basics just so you know that we do have something that helps with different age buyers, different types of properties, different situations. So that's kind of my goal here. Please don't feel like I'm trying to make you an expert in this. That's my job, to be your expert on the call. But the program that most of you are at least familiar with in the refinance part of it is the federally insured HECM. That stands for Home Equity Conversion Mortgage. And that name is exclusive to the FHA insured program that you see Tom Selleck commercials on TV about for the refinance. And these loans are very safe. They've been around for 33 years already, so there's longevity there. It's just a lot of people don't know they can be used to buy homes yet. They still think of it's just a refinance. And that's because it's been since 2009 that HUD approved these loans to be used to purchase a house. So it's really one of the best kept financing secrets out there. And it's funny because when people do discover this loan and they're smart enough to use it and get a house that they want to show off to their friends, they will tell all their friends about finding a reverse mortgage and that they should look into it too, because they think it's very smart and it was a way that they were able to buy up into a bigger, better home. But this program is available to home buyers age 62 and older. We use the age of the youngest buyer, but if you do have a couple, gentlemen 65, the wife is 60, we can accommodate a slightly under age 62 home buyer, and they also will get the same protections that are in place that we'll talk about a little bit later. So we can do a non-borrowing spouse protection is what it's called. If that 65-year-old married a 20-year-old, it's not going to be an option for them because the amount of funds they would need would be way too high. But if there's a few years difference, that's something that's absolutely doable with this. For the government FHA insured HECM, people can buy houses that are more costly than $970,800. But if you have a client buying a $1.2 million house, we can only give them a loan amount that's a percentage of that $970,800. Excuse me. Sorry. Yeah, they will be bringing more to the table if they buy a more expensive house, but we can absolutely accommodate that with this program. The new house, like I said, must be a primary residence. It could be a single family home, an FHA approved condo, planned unit development, even manufactured homes meeting certain guidelines. Biggest thing for qualifying is that your client has to have the down payment and funds that aren't borrowed. So, they can pull cash value out of a life insurance plan. They can't borrow against it, but they can pull it and use it. Same with investments, retirement funds. The departure home sale is the most common. But as long as it's not borrowed, a current asset that they have, that will let them qualify. Now, the second type of program we have is called Equity Elite, and this is a reverse mortgage program that's owned by my company, Reverse Mortgage Funding. It's exclusive to us. So we own and service these loans, as we do all the loans, actually. When you've got a certain specific thing to do with your loan that doesn't fit in the HECM program, it might fit in this program. So this is for buyers as young as age 55 in Pennsylvania. If there's seller concessions in the deal, that's not allowed for the HECM loans, but it is here. There's going to be a slightly higher down payment to these loans. I don't think I mentioned yet the most important safety feature to these loans is that they're called non-recourse loans or no personal liability loans. That means that unlike with traditional mortgages, the homeowner, when they finance this way, cannot have any additional debt at the end. So whether it's through their longevity or, knocking on wood, a housing market that's crashing at the same time that they're selling the house after living there for 25 years, if they would end up owing more on the loan than the house is worth at the time they're disposing of it, they're not responsible for that. Either my company handles that on our own because that's in our contract with them, or in the government insured loan, the FHA insurance would step in and make us whole as the lender. So since these are our loans and not government insured, the loan balances that we offer are slightly less than with the government loans. The down payments are a bit higher, but like I said, we can handle things like condos that aren't FHA approved, or very high loan values up to $4 million. So if you have a higher value home, that the loan amount is severely capped because of that just over $970,000 cap that the HECM program has. That's a good fit for this loan program. It is less costly than the other program as well because there is no FHA insurance, and that is in fact the biggest cost for these loans. So any specific, crazy things in a deal that come up, they may fit in this program because we have a lot more leniency in this program than with the government backed. I'm not going to really go through these charts, but this is something that we have in our marketing materials. This particular one is for the Equity Elite. That was our proprietary loan at Reverse Mortgage Funding. And you can kind of see an example here, home sales prices across the top and a sampling of ages down the side. And this tells you what the required investment is from your client who's looking to finance this way. On the next chart, this is the one for the FHA program, the HECM program. And I want to just actually give you an example from this chart of how this would work. So again, you've got your purchase prices, just a sampling of them across the top. You've got your home buyer age sampling down the side. So I use the example of an age 67 home buyer, and they're going to buy a $450,000 house from you. Okay. If they have a departure home that's worth $285,000 that they own free and clear, they would be able to sell that $285,000 house, even after sales costs like your realtor's fee, Pennsylvania transfer tax. They would have enough left over for their investment in that $450,000 house, because their investment is $263,874. So again, that was age 67, a $450,000 house. So that's when this program works beautifully to me, is when you have somebody with a more modest departure home. Might be where they spent 30 years, they raised their family, they paid it off, but now they don't have one floor living. They maybe have 2 acres outside that they have to maintain, and they just aren't comfortable, or just frankly don't want to do that anymore at age 67. They may not know that they have an option because they know they can't find a house out there for $263,000 that's going to suit their needs or have the amenities that they want. So when you can show them that they have, the option of using the money they can net from the sale of that house, buy a more expensive house that's maybe newer, energy efficient, closer to family, whatever it is that they need, it's a very powerful tool for you. So again, I wouldn't expect you to talk numbers like this to somebody, but I just want you to understand where the power of this is. Okay, some questions that we hear very often from your clients. Do they have to sell their current house to qualify for this? The short answer is no. The only reason they would have to sell their house first is if they have an FHA mortgage on it. You can only have one FHA mortgage at a time. So whether it's our proprietary loan or the HECM FHA insured loan, if there's an FHA mortgage on their current house, that does have to be paid off first. I have actually done quite a few HECM for purchase loans for people who had a reverse mortgage on their departure home. They did a refinance to tap into their equity. We've even had them do day-to-day backed closings. They've sold on their departure home on a Tuesday, wired the money to the Wednesday closing for the HECM for purchase. So there's no waiting period or anything like that. It can actually be done same day or just a day later. It just literally needs to be that departure home closing has to occur first. Or if the only way they can come up with their non-borrowed required investment to close is if they in fact have the net sales proceeds in their hands. In that case, again, they would have to sell that current house first, but otherwise that's not necessary. I'm sure you know as well as I do that, especially with older clients, they don't want to have a chance of having to move twice. So the timing of these things is very important to them. Who owns a home? Big misconception that's still out there. Did you have a question?
No, I thought you said who owns a home. I was answering. I was raising my hand.
Okay.
So did Juliet. I did at the same time. You do have a question?
No, I said that. I think that was in
Okay, yes, it was. Yeah.
Rhetorical question, yeah, but I love that people do know the answer to that. Honestly, I talk to bankers, financial planners who will still say, oh, that's a loan where the bank owns a house and they just let people live there. And that's not the case at all.
Yeah.
So yeah, if they buy a house and they use a Wells Fargo traditional mortgage, the house is titled to Mr. and Mrs. Smith, and Wells Fargo has a lien, so they get paid off if the house is sold before the loan's fully paid off. It's done the exact same way with our loans. Mr. and Mrs. Smith are solely on title. Reverse mortgage funding has a lien on the property, so when it's eventually sold, our loan gets paid off. So home ownership is exactly the same as it is with any kind of mortgage. If the home buyer lives in the house for 20 years or more and they end up owing more than the house is worth when it's being disposed of, are they responsible for that? I just talked about that a couple slides ago. They are not. It's very black and white in the loan closing packet. There's a form they sign that says, I understand I have no personal liability to pay back this loan. They could have 100,000 deficit. They owe 100,000 more than the house is worth when it's being sold. And because they didn't make mortgage payments or pull money out to pay cash, they maybe have 100,000 left in their retirement funds. Those funds are going to stay with their estate or stay with them if it's just them moving. We can't take that to pay back the loan. It's a sale of the house, period. So financial planners tend to really like this loan because they look at it like an estate protection tool, because all the money that that buyer keeps outside of the house is in fact protected because they're non-recourse loans. Conversely, if somebody lives in the house for a shorter time and they have plenty of equity there and they decide to move somewhere else, will they get that equity? Absolutely. Anytime that they can sell the house for more than what they owe, they pocket those net proceeds. If they live in the house the rest of their natural life and their heirs are selling the house, the heirs will get that money as well. So if they can sell the house for $500,000 and they owe $300,000, that $200,000 is going to stay with the buyer for their next move or with their heirs if the homeowners became deceased. So the fact that it's non-recourse, the fact that they can sell at any time, those are big things for people to know, because people tend to think this is a permanent solution and you can only do this if you're 100% sure you want to live in a house the rest of your life. Absolutely not true either. I have a woman now, we just closed in my 15 years in the business, but this is over the last 5 years. We have closed 3 HECM loans for this same woman. Her and her husband had a house in Delaware, hated Delaware, decided to move back to Pennsylvania. So the reverse mortgage was paid off on the Delaware house. We did a HECM for purchase loan for them in Lebanon County, I believe. Unfortunately, her husband died a year and a half into it. She just decided she wanted a smaller house and to be closer to her daughters. She sold that house they bought with a HECM, and we did a HECM for purchase on her 3rd house in a few years. So as long as one loan's paid off first, these loans can be used again. Okay, so how can these loans help you increase your business? So I think all of you who've been in the business for a while, when you talk to a current homeowner that's 55, 65, older, you realize that their buying decisions are very different than that of younger clients that you're working with. They're thinking about things like they want this house to be the best house it can be. They want those amenities. They want brand new, sometimes if they can get it, low maintenance, close to family, because they feel like this house that they're buying is probably going to be their last house ever. So it really needs to be what they want it to be. So that's an important thing. And I think this higher buying power that they have with using this loan is important with that. But the other thing is they realize that what they've managed to put together in assets over their working years, they have to retain that as long as possible. They don't know whether they're going to live 5 years in retirement or 30 years in retirement. And the funds that they have to last throughout those years. So they want the best house that they can have, but they want to do it in a way that it's fiscally responsible, and it's not going to happen at the expense of them possibly running out of money. I'm sure you've all heard the quote from that study that people are more afraid of running out of money than they are of dying, right?
Julie, we've got a question from one of our,
Okay.
Karen's got her hand raised. Karen, what's your question?
Okay, just like to more simplify this. So whenever they put down their percentage, whatever it was, 55% or whatever it was, you said they don't have to make payments.
Correct.
Is that correct?
Correct. Yeah.
So, but they still own the house.
Correct.
I'm
So the
kinda
loan
just
balance,
like little-
loan balance would rise. So instead of them sending maybe $1,800 a month in for a payment, and then of course we know 1,600 or more of that would probably be interest, right? They're not going to have to send a payment in, but the loan balance is going to grow by the interest amount. So it's a rising balance loan.
So that money's still owed on the house? Like,
Right.
okay, so they die and then their kids inherit the house. So, but if they never make payments, then what happens?
So they can will the house to whoever they're going to will it to, just like they would any other way they own the house. If most often the kids don't necessarily want to move into mom and dad's house, they're probably going to sell it. So if they can sell the house and sell it for more than what the parents owed on the loan, that's what they'll do. They'll sell the house. Our loan would be paid off for whatever is owed. If they had the house 10 years, they'd have the starting loan balance and then 10 years of interest that's been added on, okay? If they sell it for more than what's owed, they're going to pay off the loan and the kids are going to split the net proceeds that are left over. If the parents were in the house for a whole lot of years and never made payments, then there's a good chance it would be what we call technically underwater, meaning they owe more than the house is worth when it's being disposed of. Frankly, if that's the case, they've made things really easy on the heirs, because the heirs could just take 30 days, get mom and dad's possessions out of the house and do a deed in lieu, not go to the hassle of trying to sell the house if there's no money for them to get. So there's no chance of them having additional debt. If it's the parents lived in the house for 20 plus years and then had to go into a permanent nursing situation and it's them selling the house, they have no chance of debt at the end. Worst case is they lived a long, happy life there, never made payments, and they're going to walk away and not have any net equity to take with them or for their heirs to have, but there's no chance of debt for any of them.
So then the house just reverts back to the loan company at that time?
If it's underwater, yeah. If it's not underwater, the family is going to want to sell it, of course, and hire you, put it on the market, sell it, pay off the loan, and pocket the difference. Yeah. Does that make sense?
So they basically can buy a house for like half the cost, or am I reading this wrong?
No. Depends on the age, but yeah, it could be roughly 50% to, 58%. It's hard to tell with the rates changing so often right now, but yeah.
Okay.
Yeah. So to keep it simplified, let's say they're 67, you're selling them a $400,000 house and their investment of funds is roughly $200,000. So they're going to have a starting loan balance of $200,000. And that loan balance, if they never make payments, is going to go up. And of course, the home value started at $400,000. If we're in an appreciating market, the home value is also going to go up. Sometimes when you look at the amortization schedule on these, you actually see the buyer gaining equity for the first 4 or 5 years, because if it's appreciating 4% a year, 4% of that 400,000 home value is significantly higher than the interest they're being charged of the starting balance of 200,000. So it's not like people think, like you drive a new car off the lot and it's all of a sudden plummeted in value, right? It's not a situation like that. It actually takes quite a few years for it to get to the point where the loan balance would meet what the house is worth.
So in this scenario, the $200,000 that they owe, you said you are charging interest on that?
Right, but instead of them sending payments in to pay that interest each month, the loan balance is just rising. It's being added to the loan balance.
So after 20 years on $200,000, they could actually owe whatever, 300,000 instead of 200,000.
Yeah, it could be more like 400,000 or more. I'd have to look at an amortization schedule to be sure, but yeah, but the home value has also been going up, hopefully, as well. So.
Okay.
Go ahead. Did you have another question, Karen?
I was just going to say, in her experience, then, the most, if people don't make the payments, does it basically just even out at the end?
Depends on how long they're there. I mean, I've seen it where I've had, heirs call me. Remember, since it's only been since 2009 you could do this. So there's not a lot of really long-term history as far as the purchase of it. I've got a house right here in the community I live in, one block over, where I worked with the home buyers, and the wife just died and the husband needs to sell the house because he's going to be going into a nursing home because he can't live by himself. They have been here, I want to say 8 or 9 years. We looked at their home value and what they owed, and even being here 8 or 9 years and never making a payment, he's going to walk away with probably $150,000. A very big part of what, a very big part of what their initial investment was, actually.
Because they put so much down, right? Lorna's got a question real quick here. Lorna?
Well, so if they decide not to make a payment, is it going to go against their credit?
No, these loans actually don't show up on a credit report.
Not defaulting.
Like it's not a promissory mark or anything like that?
Yeah, they're not required to make payments. So you don't even see these loans on credit reports, which always seems very odd to me, but they don't have an obligation to make a payment. So you just don't even see these on credit reports. They can't default. The exception is that they're responsible to pay their property taxes and keep homeowners insurance in force. So really the only way to default on these loans is to default on their property taxes.
Okay.
But you lose a house if you own it free and clear, and there's no bank that has a security interest in it if you don't pay your taxes for months. Yeah, it's always an important thing.
I want to use an example because not but maybe 2 weeks after I first met with Julie and we started scheduling this event, Allie and I have sellers out in Westmoreland County, and it's an older couple. He's had a couple of strokes, and their children live, one's in DC and one's in the Outer Banks. So imagine the value of their home in Westmoreland versus what they're going to have to pay if they're deciding to go to either DC or Outer Banks to be near one of their kids. And so I had a quick email exchange with Julie just saying, hey, I'm sharing your contact information because this seems like it would be a good fit, because we can easily, I think, sell their house in Westmoreland for like 200 plus or whatever, great little house. But then they can qualify at their age for something more in the price range of what they're going to have to pay for in DC or Outer Banks. And furthermore, all they're going to have to do to get that is continue with payments of insurance and taxes. So they aren't paying on that, principal. Again, the goal was to connect them to an amazing realtor in each of those locations to make sure they're getting a good investment. And purchasing, just at the right time in the right place. But I just really feel like for us, especially, I have a seniors real estate designation, the SRES rather. And so I do work with folks that are downsizing or having to relocate for these reasons. So again, it was just going to be a great option. And we have parents, my mom too as well. So Julie, is there anything, and one thing I don't think I remembered you saying, there's no refinance into a HECA, right? Or is it just like initial purchase?
Oh, no, you can actually do a refinance. That's what's been around for 33 years already. It's just that you used to buy a house has been just since 2009. I've had times where it's been just a really hot market and a seller was going to get multiple offers on a house, and all the realtors knew they were going to take a cash buyer period. I've had situations where I've had people who wanted to finance with my loan, but they fortunately could put that money together and make a cash offer. They purchased the home with cash. 2 days later, I'm taking their application to do a reverse mortgage refinance so that I can help them get some of their money back out of the house. So yeah, if you have somebody who decides to stay in their house, we can, and they spent 30 years paying it off, but now they're maybe feeling house rich, cash poor. they can do a refinance and tap into their equity and set up a line of credit or monthly draws to themselves of loan proceeds. There's a lot of ways these loans can be used as kind of high-level financial planning, frankly. But with using it to buy a house, it's the same loan. Excuse me.
It's hard to always be the speaker. I feel you.
Yeah, just a little bit of a different benefit. So basically on a purchase, they're getting the payout of the loan 100% on day one to combine it with their money to purchase the house. So there's no future draws of money to them or anything. But on a refinance, if somebody, you know, is older and they've retired, but they haven't fully paid off their mortgage, they might want to look at doing one of these loans so we can get that mortgage paid off for them. They still have the debt, but not the monthly payment. So yeah, it can be a refinance, it can be a purchase.
What if like an heir does?
I had another question.
Hold on one second, Karen. Lorna, go ahead.
What if like they heir the house, so what if their kid does want to live in the home?
To keep them after the
Yeah,
individual.
and they continue.
Yeah, what happens there, if you're no longer fitting the age qualification gets the loan, but say, for example, unfortunately, something happens to that individual, can an heir who inherits the home just move in and continue the payments at that point?
No, the loans aren't assumable. The events that make the loans, excuse me, due and payable would be if the last of the borrowers dies, last of the borrowers has to permanently go into nursing care, or they just decide to sell their house to move somewhere else. That creates a due and payable event for the loan. So if the parents became deceased, the loan is now due. If the heirs are selling the house, they do have up to a year to sell the house, 6 months and 2-3 month extensions. So they get plenty of time to do it. But if in fact they wish to keep the home and move in, if it's not underwater, they basically need to get their own loan to pay off the reverse mortgage for whatever the balance is, and then they'll own that house.
Right.
Karen?
If it is underwater,
Okay.
only though, we would not expect an heir to pay more than the house is worth. So let's say somebody owes $500,000 on the house. They die, their kids decide they want to keep the house, an appraisal would be done. If the house is in fact only worth $400,000, the heir can actually buy the house for 95% of $400,000, even if $500,000 is owed on the loan. Yeah, so the heir can buy it for 95% of the appraised value or the loan balance, whichever is lower.
Okay, Karen?
So the qualifications again for these programs is just your age and the fact that you would have the down payment. Is it the only two qualifications? Does a credit score or anything else come into play?
It does. So our underwriting is similar to traditional mortgages, but a lower bar. We have different things that we can use for income calculations and such. So we don't use the traditional debt to income ratios you're used to hearing about with regular lending. But because they do have obligations of taxes and insurance and HOA dues, we of course need to be comfortable that they're going to be comfortable making those payments. So we would look at the obligations on the house they're buying, taxes, insurance, HOA. If they have any other properties owned, we'd look at those obligations, and then in credit report obligations. We compare that to their income. If you've got a couple in Pennsylvania, they need $906 more of income than they have of obligations. So that's not a tremendously high bar. And they do need a good credit history. So we're not like FICO score specific, you know, that doesn't affect rates or anything like that, like it can in a traditional mortgage. But they do need to have good payment histories, especially on mortgages, but also on property taxes and any other loans or credit cards they have on their credit report. They do need a good credit history. Yeah. Did that answer that fully?
Yes, thank you.
And we do pre-approvals just like your forward lenders as well. We would get income documentation and pull credit and do all of that stuff to be 100%, you know, sure that they're qualified, so we can issue a pre-approval letter so they of course can, you know, get the house that they're looking to buy.
Love it. Any other questions? Yeah, wonderful. Julie, if there's any other resources or information you have to add, I'm just supremely grateful. I think we've got a lot of folks here bouncing their heads saying this is incredible information and a great tool for all of us in our toolkit here as we're dealing with folks in that bracket. So thank you.
Good.
Thank you.
Any of you that have questions, this is one of those things that as you think about, more things pop into your head. Feel free to shoot me an email, give me a call. I love talking about this stuff, so you won't bother me. I can probably answer it off the top of my head. And if you have a client that you want us to talk to, it is so helpful if you have people, you know, you're going to get 2 deals out of it. If you're meeting with this couple who think the only way to not have a mortgage payment is if they can, you know, trade houses equally, and they know that can't happen with what their current house is worth.
Yeah.
When you can show them that they can sell their more modest house, get exactly what they want, still not have mortgage payments, it's a good chance you're going to get the listing on the departure home and find them their new house that has 1 floor living or is closer to family or whatever it is that they're looking for. So when you look at it that way, this can really increase your business, and it's not going to replace your people who would buy anyway with cash. We don't compete with your preferred traditional mortgage lenders because we don't do those. This is just a whole standalone thing that when you know about it at the right time can help increase sales.
Yeah. Julie, can you please add your email address in the chat so that everybody can get a quick look at that before we sign off?
I will, yeah.
It's jdidyoung@reversefunding.com.
Yeah, that's right.
jdidyoung@reversefunding.com.
Yeah, and if you're, I don't know if Alana was going to send me a list of who was on here with emails. I can always send emails out to them just to open the lines of communication as well.
Yeah, we can do that.
Perfect.
Jump on that. I took a picture of whoever was in here. Thank you again. We really appreciate your time. And if anybody has any questions, they know how to find you. I'm sorry, my screen went down there. Thank you again. Really appreciate all your time. Thank you.
That was my pleasure. Take care, everybody.
All right, everybody.
Bye-bye.